When many people become permanent residents in Canada, one of the first major adjustments they encounter is the Canadian tax system. Unlike some countries where taxes may be simpler or deducted in different ways, Canada uses a progressive tax structure that combines both federal and provincial taxation. This can make the system appear confusing at first. However, understanding how taxes work is extremely important because it influences many financial decisions, including how much you save, how you invest, and how you plan for long-term financial goals. And later in this video, we'll walk through a simple real example showing how someone earning $60,000 per year is actually taxed in Canada, which often surprises many newcomers. In Canada, income taxes are collected at two levels of government. First, there is federal income tax, which is administered by the Canada Revenue Agency and applies across the entire country. Second, there is provincial income tax, which varies depending on the province where you live. For example, someone living in Quebec will have slightly different provincial tax rates compared to someone living in Ontario or British Columbia. These two layers of taxation combine to determine the total amount of income tax you pay each year. One of the most important features of the Canadian tax system is that it is progressive. A progressive tax system means that income is taxed in stages, rather than applying a single tax rate to your entire salary. Many newcomers initially believe that if they move into a higher tax bracket, their entire income will suddenly be taxed at that higher rate. Fortunately, that is not how the system works. Instead, only the portion of income within each bracket is taxed at that bracket's rate. Let's look at a simplified example. Imagine someone earning $60,000 per year in employment income. The first portion of their income is taxed at the lowest federal tax bracket. As income increases, additional portions move into slightly higher brackets. This layered approach ensures that individuals with higher incomes contribute more, while still keeping lower income brackets taxed at lower rates. When people receive a job offer in Canada, the salary usually refers to gross income, which means the amount earned before taxes and deductions. However, what truly matters for budgeting and financial planning is net income, the amount that remains after taxes are deducted. For someone earning $60,000 annually, the monthly take-home income may be significantly lower than the original salary once federal tax, provincial tax, and other deductions are applied. In addition to income tax, most employees in Canada contribute to programs such as the Canada Pension Plan and employment insurance. These deductions help fund national programs designed to provide retirement income support and temporary financial assistance during unemployment. While these deductions reduce immediate take-home pay, they also contribute to long-term financial security. Taxes do not only affect your salary, they also influence how investments are treated. For example, interest income, dividends, and capital gains can all be taxed differently depending on the type of investment and the type of account used. This is one reason accounts such as the TFSA and RRSP are extremely valuable, because they allow investors to reduce or defer taxes on investment growth. Earlier in the video, we mentioned that someone earning $60,000 may pay less tax than many people expect. But there is another important factor that can reduce taxable income even further, and that involves using certain registered accounts strategically. One of the most effective ways to optimize taxes in Canada is by using tax-advantaged accounts. For example, RRSP contributions can reduce taxable income today, potentially lowering the amount of tax paid in the current year. Meanwhile, the TFSA allows investments to grow tax-free, meaning future gains are not taxed at all. Earlier we discussed how someone earning $60,000 might pay less tax than expected because of the progressive tax system and available deductions. When individuals understand these mechanics, they can make smarter financial decisions, from retirement planning to investment strategies. Understanding taxes is not just about compliance. It is about using the system effectively to build long-term financial stability in Canada.